Welcome to this FinGraphs podcast on Dukascopy TV. Today we're going to look at something new. We've AI'd some of our analysis process and can present to you price projections. We believe the system has a simpler visual effect in order to interpret our charts. You know our traditional visual on fingraphs.com with three frequencies, the weekly, the daily, and the hourly update. And with our trend analysis, which in this case is still bullish on all three frequencies, as well as our risk-reward analysis using our envelopes, as well as our target system, and our risk index, which gives us a sense of market risk, going from oversold to overbought. Now, to do our price projections, we've relied on an older system we had, the Decider, which basically analyzes the oscillator sequences and compares them to a model to be able to understand where the cyclical dynamics are going over the next few months, quarters, or years. And this up to now was happening with an overlay where we would basically overlay our interpretation of the oscillators and of their sequences. We would overlay some ideal models, which in this case, for example, for the S&P, would tell us that there is probably a bit of consolidation into December and then a further rise into late Q1, early Q2 on both oscillator series. This is a weekly graph. Now, we've AI'd this process, and basically the machine is doing this interpretation by analyzing our oscillator sequences and giving us pretty much the same scenario into early next year or late Q1 next year. And then we take these oscillator sequences and the projection on these oscillators and convert them into price projections using historical volatility. To have a more robust projections, we then go into the market and look at related assets. So here, for example, you have the inverse relationship of bonds versus equities. You have a growth ETF in the US, as well as the ratio of high yield versus investment grade in the US. And if you see the oscillator sequence are quite similar to the one we're looking at on the S&P. We then put everything together, weigh the projections on the instruments, so the S&P and its related assets for 50-50 each, and this results in a price projection. So what you have on this screen is that you have the price up to today, and you have the projection of what we expect could happen into the future. So we expect a slight consolidation into early December here, and with a trade which could probably last a couple of weeks, and then a further rise probably into spring next year, and possibly up to 5,000 and perhaps even above. On the right-hand side, you have the correspondence of the historical models we find with our ideal models. And here you have the cross-asset pertinence, which means that we compare the projections we have on the related assets to the projections we have on the S&P 500 and look at to how similar they are. So both scores here are out of 5. And then we have a max upside potential, which is pretty much here, and the downside risk we would expect is probably towards the lower end of the envelope here. So basically a projection system, but also a swing trading system in a way. We've also looked in this matter at the dollar index. The dollar has been very strong this year and especially over the last few months. We expect it to come to a top and enter a consolidation period. It should have an initial period of correction, which could be quite strong into late January, and then possibly some further consolidation into mid-year. We do explain this by the resilienceness of US inflation expectations, which we expect to continue higher into the spring. Well, first of all, into late January, February, and then to extend up into the spring. And finally, we believe that this cross-asset mix is very favorable for gold, which we see rising probably into late Q1, early Q2, and perhaps reaching towards new highs towards 2,100. Thank you very much for your attention, and we wish you a very good week of trading.